Hi guys, I'm Phil Town from Rule 1 Investing, and today I'm going to talk to you about the impact of fear on the market and on us. As a reminder, make sure you click the subscribe button and the bell icon to get notifications when I release new videos. When your retirement savings are on the line, if you're just getting started or if you're a seasoned investor, you can be seriously impacted by fear of your investment choices. Hey, it's a fact that people are emotional. In fact, it's what makes it possible for us to do great in the stock market is that people are emotional. But guess what? We're people and we're emotional too. And while everybody wants to protect their nest egg, it's really hard to just stay rational about it when things are going badly. The catch is this: emotional people make for really bad investors. So somehow we have got to get ourselves apart from being emotional. As Buffett said, if you cannot control your emotions, you cannot control your money. Now, why is that? Because the market can make you crazy. That's why. If you were to react to the market and all of the fear everyone has as the market starts to go down, or all the greed people get into when it starts to go up, you're going to end up with less than you started with every time. This is people's biggest mistake in the market. The market is not a rational place all the time. There's fear that moves the market around a great deal of the time. So let's talk about what market scenarios trigger the most fear in investors and what you can do as a Rule 1 investor to take advantage of that situation. Here's the first scenario. People close to or in retirement tend to pull their money out of the market at exactly the wrong time. Now here, I get it. People close to retirement are more sensitive about the market going down than those who have time available to wait for the market to recover. There are 75 million baby boomers out there in the United States, and many of them have money in the market, about 50 million of them. And if they all pull their money out because they fear big losses before they retire, you're gonna see the market really accelerate down. And you guys, a big dip in the market means it's an ideal time if we've got our watch list all set up for us to step in and be buyers in that market. So the fact that there's all these baby boomers out there is a pretty good indication to me that we're going to see a major market downturn when it really starts to happen. And we want to get ready to take advantage of that. All right, next, when there's a lot of fear in the stock market, investors tend to retreat toward what they feel are safer investments. Now, these are often professional investors that manage a lot of money. And one of the things they retreat to, besides bonds, are commodities. So fear starts to overtake the market, stock prices begin to drop, and some investors shift their money into safer things like gold and silver. This means that in many cases, gold and silver tend to go up at times when the market's going down. Gold and silver are often thought of as fear trades. Now, what I would suggest to you guys is leave that sort of investing to the professionals, let them lose somebody else's money. There's nothing surefire about this strategy. And the problem with gold and silver is you can't eat it, you can't drink it, you can't wear it, you can't run your car on it. It's just a lump. You can go up and kiss it, I guess. The price of these things gets to be really crazy sometimes, but I honestly have no idea about how to invest in it, and frankly don't consider it an investment at all. It's pure speculation. So while it often does okay while the market's doing poorly, it's not for us. So let's be just aware of the relationship between these so-called safe commodities and the presence of fear in the market, and not get caught up in getting sucked into those things. What we want to do is we want to be ready to buy when the market's crashing and not be fearful. We want to be able to pull the trigger then and really get into some great companies, not jump into a fear trade like gold. So as a Rule 1 investor, how can you take advantage of fear in the stock market is what it really comes down to. Fear in the market is always a precursor to a bear market at best and a recession at worst. Fear tends to have a domino effect on the market. More and more people start to exit the market. More and more people start to exit the market. And it can create a really serious chain reaction that can drive the market down to extremely low valuations. I got to tell you, Carl Icahn is making the case out there right now that these index funds are going to result in incredible volatility when the next time the market starts to tumble, because those index valuations are not connected to anything except a big basket of stocks. They have to sell them as people start getting out of the index. The more they sell, the more those stocks go down. The more people want to get out of the index, the more those stocks go down. So it turns into a really dangerous situation where the volatility of indexes can be extreme. Now, here's what I want you guys to do. If you're able to learn this stuff I'm teaching, and you can keep a level head, and you are patient to wait on the market, this market will recover. It will go back up. America will be successful. Well, guess what? When that market crash starts to happen, this is an incredible opportunity. When I was working with one of my first classes was over in Singapore, whole group of Singapore students right at the beginning of the last major market crash, June 2009, and they picked a portfolio of 10 stocks, put in $100,000 of paper money into these 10 stocks, 10,000 in each one. The stock market, just being in the index, has done extremely well since June 2009 until now. It's averaged about 13%, which is extraordinarily high for the stock market. And that $100,000 invested in the index would have become about $300,000 so far, which is quite good in 10 years, right? Well, guess what? That portfolio of stocks, those 10 stocks that they picked, when they learned something about this, went from $100,000 to $1.25 million. And that's what I want for you on the next time. The beginning of the next major decline, there are usually really good reasons why people are really concerned. Stock prices are dropping, the sky is falling. Before long though, fear itself becomes the primary factor that's driving the market down. And if you can understand that, you can be in a position to take advantage like those people did 10 years ago. And what this means is that the price of many great companies will be dramatically lowered for no other reason than the fact that people are afraid and pulling their money out of all these indexes. If you can push past your own fear based on your knowledge about this company, based on the company's certainty of being around in 10 years or so with a good management team, and you get the margin of safety price, if you can buy when these other people are selling, this is how you can get rich. You can get companies at rock bottom prices. And that's one of the most exciting things in the world. Now, with that said, it's still essential to invest in the right companies, even at a time when lots of companies in the market are, they're going on sale relative to their value. And a lot of people will say, just throw a dart, blah, 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 buy the index, whatever. Not all companies are going to survive the recession, which is why a group of companies, a large group of companies, where you're kind of spread out across 100 things, is going to be driven down. The returns are going to be driven down by the companies that fail, the companies that go bankrupt and never recover. Now, during a recession, you've got to pick just the companies that are strong. These are proven companies that you understand, that have good funds. There's no debt there to get beat up by. They've got a really reliable, great moat, and management is awesome and will survive the downturn. Now, how would you know that? Well, the most awesome thing is we had our last huge recession back in 2008, 2009. Just look at the companies that you're picking on your watch list. How did they do in 2007 to 2010? How did they do? If they're stronger now than they were then, a really good indication that these guys have a big moat and they're a great company to own. Now, I'd love to hear from you guys. Do you think we're headed for a recession and a stock market crash? So leave a comment below with your answer and I'll be sure to follow up with you. And thanks for watching. Now go play. If you guys enjoyed this video and you feel it was valuable in teaching you more about how fear in the market makes the market move, hit the like button and please share this video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen for a free gift. And thanks again for watching.